Hi folks, welcome to this video on calculating earnings per share. Our focus here will be on calculating the numerator in the calculation of the earnings per share. So let's begin with a definition of what EPS, or commonly known as earnings per share, is. It really tells us that for each common share that an investor buys in your company, how much can the company make in income with the money they received from that share in order to make a profit for the company. That gives the investor who bought into the common shares some kind of a loose measurement for what they could get at the top end for a dividend. Don't forget, common shareholders are very rarely specified the per share dividend when they buy the shares. So they're residual interest shareholders, meaning that they don't know what their dividend's going to be. So calculating an earnings per share for common shareholders is a very important measure in that regard. So what's the formula for calculating earnings per share? Well, as we see here, it's income less preferred share dividends divided by weighted average common shares, or what we call WACs for short. Now, I did say up here in the title that our focus on this part of the EPS calculation will be on the numerator, this part here, because where students sometimes get confused is in what to do with the preferred shares. Do we deduct them or not? Well, we've put down here some rules for you. If the preferred shares are non-cumulative, meaning that any missed dividend payments do not have to be made up when the dividend is declared. The only time you deduct the preferred share dividends are if they're declared. So you only deduct them if the preferred share dividends are declared. If the preferred shares are cumulative preferred shares, and that means that if any dividend payments are missed to preferred shareholders, the next time a dividend is declared, you have to pay those dividends in arrears or the unpaid from the previous years first. Then the rule for calculating the numerator here in the EPS calculation is to deduct only the current year's entitlement, and we ignore arrearages, whether that current year's entitlement is declared or not. Why do we do that? Well, because we know that at some point in time we will declare preferred share dividends and we will have to pay them. So any of the current year's entitlement we deduct from this year's income to find EPS. So now, with those rules in mind, let's do an example. So let's assume here that we have a corporation that earned income of $450,000. They have common shares outstanding all year long of 200,000, so that's our weighted average common shares. So we don't have to do a calculation here. And the preferred shareholder receive a dividend totaling $10,000. So to calculate the earnings per share, we use our formula, which we have here. Now, don't forget, we have preferred share dividends that were declared. So regardless of whether the preferred shares are non-cumulative or cumulative, the fact is, even if they're declared, which they are, or even if they're declared down here, or even not, we're going to deduct the current year's entitlement. So therefore, we would deduct the $10,000. So therefore, we're going to have earnings per share at $2.20 per share. Now, let's look at another example that has a few more complications in it. In this example, Bellevue reported $860,000 for its year ended December 31st, 2014 in net income. They want us to calculate earnings per share given the fact that the preferred shares are cumulative. The per share dividend is $2, so I'm getting that in here. And they tell us something about the common shares as well as retained earnings. They tell us that to calculate retained earnings, we also had dividends or cash dividends in there of $100,000 to help us come up with this ending number. So we know that the dividends declared this year were $100,000, and we also know that there were no dividends in arrears. So this $100,000 payment did not cover arrearages. So now, for us to calculate earnings per share this year. We know our formula, and we also know that there were no changes in the outstanding shares during the year, so we know we're going to use 160,000 shares issued and outstanding for our weighted average common share piece of the calculation. So now, the fact that the preferred shares are cumulative should remind us of our rule. If they're cumulative, deduct the current year's dividend entitlement, whether it's declared or not. Well, the current year's entitlement would be the per share dividend of $2 a share times $26,000. Well, we declared $100,000, so $52,000 went to preferred shareholders, and the other $48,000 would go to common. Now, we don't need the fact that $48,000 went to common to do our calculation of earnings per share, but I'm just making that point. So we would deduct the $52,000 because it was declared as part of the $100,000, divided by our weighted average common shares, and that would give us $5.05 per common share as our earnings per share. Now what we're going to do is we're going to use some of this data in the example, but we're going to change it a little bit. Let's assume that the total amount of the dividend declared during the year was $50,000. So remember up here, we assumed it was $100,000. So now the preferred shares are still cumulative. We didn't change the per share dividend of $2. We didn't change the number of preferred shares issued and outstanding. But the question comes, what do we deduct? Do we deduct $50,000 or do we deduct the $52,000 that we deducted here? Well, we know that the annual current year entitlement would be $52,000. But if we go back to our rule, because our preferred shares are cumulative, we know that we deduct the current year's entitlement, which is $52,000, whether it's declared or not. So in our example, $50,000 was declared. The or not piece is the other $2,000 of the $52,000. So our EPS calculation won't change. We're still going to deduct the $52,000 because that is the entire current year entitlement for those cumulative preferred shares, and this is our rule for cumulative, right? Even though the whole 52 wasn't declared, because it's whether it's declared or not. So we're still going to get $5.05 a share. Let's look at another example using the basic bones of that example too. So now let's assume that we declared $50,000 in dividends and the preferred shares are non-cumulative. So you know that the regular entitlement would have been $52,000, but the shares are non-cumulative. So we can only deduct, because the shares are non-cumulative, only the preferred share dividends that are declared. So if we only declared $50,000, that's all we can deduct because the preferred shares are non-cumulative, and that will give us $5.06 per share. Now let's look at another example. Let's again use that example in data 2, but let's assume that no dividends were declared this year and the preferred shares are non-cumulative. Well, if we go back to our rule, we can only deduct preferred share dividends that are declared. So that's if they're non-cumulative. So now we would deduct nothing in the numerator because the preferred shares are non-cumulative and we declared no dividends. So in essence, the preferred shareholders aren't owed anything this year and even in subsequent years in terms of arrearages because we didn't declare anything and the shares are non-cumulative. So we're going to get $5.38 per share in this case. Let's look at a final example. Let's assume, again using the same data as in example 2, which again, just to refresh your memory, example 2 is up here. All right. Let's say that in this final example, the company declares $104,000 in dividends. The preferred shares are cumulative, and this payment includes 1 year of dividends in arrears, find the EPS. Well, again, we know that the $104,000 that was declared, because it includes 1 year of arrearages, those arrearages for the previous year would be $2 a share times 26,000 shares. That was in our example 2 right here. $2 a share times 26,000 shares. So that means in a previous year they didn't pay 52,000, but in this year when they declared, they decided to pay the arrearages of 52, and because they have declared enough at 104,000 to clear them all off, they're also going to pay the current year at 52. So in other words, that 104,000 is picking up dividends in arrears for 1 year and the current year dividend of 52,000. But don't forget, because the shares are cumulative, we deduct only the current year's entitlement and ignore arrearages. So the current year's entitlement for 1 year would be 52,000 of the 104. So we only deduct that in the numerator, divide by our weighted average common shares to get 505 per common share. So this concludes our review of the calculation of earnings per share with our focus on the numerator. I hope you found this video helpful.